Zscaler shares dropped close to 10% after the company reported the latest earnings report. Now, you might think that 10% drop means that it probably missed on some estimates, right? Well, actually, no. A beat across the board for this report and also for guidance. They even raised their outlook by a tiny bit. So what exactly has happened? Well, some say some people were taking profits, the other are still fearful of what Palo Alto reported just 10 days beforehand. Palo Alto crashed 20+%. Since both of them are in the same industry, the cybersecurity industry, then maybe that led to a further drop. The stock is also up quite a lot in the last year or so. So again, valuation does matter at a certain point. There's also a bit more to the story. I do want to touch on a couple of points that were mentioned during the earnings call as well. Very, very impressive. By the way, for those of you that don't know, Zscaler isn't a company that has been around for decades. Zscaler was actually founded just 6 years ago. And yet, this company is growing quite fast, generating quite a lot of free cash flow as well. Now, if you need a, let's say, 101 class of Zscaler and maybe Palo Alto Network, here it is. So Zscaler is cloud-based, offering easy deployment and scalability, while Palo Alto Network requires on-premise hardware and can be complex to manage. Of course, again, this is a very, very basic summary of both companies. Zscaler focuses more on secure access service edge, providing a unified platform for various security features, such as zero trust, while Palo Alto Networks is known for advanced firewalls and offers broader security solutions. Zscaler excels in ease of use, global reach, and secure access service edge features. Palo Alto boasts extensive security options, advanced firewalls, and deeper product integration, especially now with the offering, right? The platformatization that they've announced. Short-term hit on the business should lead to long-term monetization, long-term success of the company. But right now, as always, Wall Street doesn't like uncertainties, and so it hit that stock, which was also, by the way, very, very richly valued. Now, currently, Zscaler has a market cap of $32.52 billion, so still small-ish compared to the other huge players out there. As I said, the returns since last year have been quite remarkable. It's up 70%. And then if we look at valuations, PE-wise, a forward PE of 77 times, so definitely not the cheapest out there. EV to sales in the next 12 months, 13.2 times. Of course, we've seen more expensive and we've seen less expensive players in that industry. Now, if you look at what the analysts are estimating for fiscal year 24, 25, and 26, you can clearly see that this still is a high growth company when it comes to revenue and even EPS. Now, if we quickly look at the valuation metrics compared to its 5-year mean, you can see that in the last year or two, it has become more profitable. It has also become less expensive on those metrics right here, because before PE was extremely high, EV to EBITDA was extremely high, even price to sales was at 40x at one point and even more. Price to free cash flow, that's in the last 12 months, sits at 60.9 times compared to close to 200 times in the last 5 years. As for the analyst price target, the market is still quite bullish on this stock. You can see that the average price target still sits at $257, representing close to 17 to 18% upside from the price we're at today. There are 42 analysts covering the company. The majority has a buy rating. So you can already conclude right now that Zscaler is a tremendous business, a high growing business, not a cheap one, but as we've seen in the past, plenty of companies that are growing quite fast, that are profitable in their own ways, have always been richly valued by the market, because those are special types of companies that the market just won't give you the opportunity to buy it at, let's say, a cheap valuation. You can conclude that this will continue for quite a while, unless obviously they stop executing the way they've been doing the last couple of years. So far, I don't see any indication of a lack of execution here. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we'll really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, looking at their second quarter fiscal 2024 financial results, revenue increased 35% year over year. Calculated billings grew 27% year over year. Deferred revenue grew 35% year over year. Now, I've already heard some comments that were saying that maybe because billings only grew 27% and revenue is increasing quite faster than that, maybe that's also, let's say, an orange flag. Remains to be seen what happens in the coming quarters. My anticipation here is that we're going to see calculated billings re-increase. Might not happen next quarter, but I do think that eventually you'll see a bump there. GAAP net loss of $28.5 million. So yes, this is still an unprofitable company when you look at GAAP. Non-GAAP net income was $121.1 million compared to $57.6 million same quarter last year. Then looking at outlook for next quarter and for fiscal year 2024. So for next quarter, they expect revenue at the midpoint of $535 million, non-GAAP income from operations $99 million at the midpoint, and non-GAAP net income per share of approximately 64 to 65 cents. As for the full year, they raised the guidance for revenue and for billings as well. So revenue to be approximately $2.11 to $2.12 billion and calculated billings $2.56 billion at the midpoint, with non-GAAP income from operations coming closer to $400 million. So far, so good. Now, let's jump into the earnings call because we got way more information and way more interesting stuff to go over. First up, with regards to ARR. So our existing opportunity-led sales engine has helped us deliver strong growth over the years, enabling us to surpass $2 billion in ARR. Now, going back to what they said before, they want to scale up and for their business to reach $5 billion in ARR and beyond. At the current growth rates, they're right on track. They now have a double-digit number of customers spending more than $10 million with them annually. Driven by upsells, their $1 million ARR customers count grew by 31% year over year, ending the quarter with nearly 500 of those customers. With regards to the $100,000 or more ARR customer base, that grew by 21% year over year, ending the quarter with over 2,800 of those customers. Again, you can see this is still a company that is growing extremely fast. As for the trailing 12 months dollar-based net retention rate, that was 117%. While good for the business, their increased success in selling bigger bundles, selling multiple pillars from the start, and faster upsells within a year can reduce their dollar-based net retention rate in the future. I do believe that this percentage has come down slightly each and every quarter. Now, touching on free cash flow, the free cash flow margin was 19%, including data center capex of approximately 6% of revenue. This is going to be a tremendous free cash flow machine for the future. They ended the quarter with over $2.4 billion in cash, cash equivalents, and short-term investments. Then they continued by saying here they expect their free cash flow margin to be up year over year and in the low 20% range. Again, this is exactly what you want to hear. I know some people will say, yeah, but on a GAAP basis, still unprofitable. How can you buy such businesses? Well, I'd rather see a company with free cash flow margins like this and growing than wait until they are GAAP profitable. This is already showing you how profitable this business will become in the future. And so finally, looking at the graph right now, some of you might not like what I'm about to say, but if we look at the 200-day moving average, that's under $200, closer to $186. The 50-day one sits at $228, and the 20-day one sits at $239, which is obviously higher than the price we're at today. And as always, watch out for that $200 mark. We've seen this in countless of other graphs where round numbers get respected. So maybe this time, if you are a deep buyer and you want to wait a bit more, $200 definitely an area to look at. And then, of course, the 200-day moving average at around 186 is definitely going to be an area where I could see quite a lot of buying activity. Previously, back here in August of 2023, the stock did dip a little bit under the 200-day moving average, but since then, it has been over that and going up and up and up. Of course, before the earnings report, as you can see in the past couple of weeks, the stock was heavily overbought. We're now back at around 56.82 when it comes to RSI. So overall, to conclude, Zscaler, a tremendous business growing extremely fast, top and bottom lines, even raised their own guidance. So that's great. But the market is now telling us there's always a correct price to pay for such stocks, especially for those that didn't buy it before, right? The stock is up 70% year over year. So it makes sense that sometimes these types of companies, these types of stocks do dip despite great reports, profit taking, the market seeing maybe better opportunities elsewhere, or just giving you a better opportunity to open a position in such a company. For me right now, it still sits on the watch list. I'm still waiting. Maybe I'll get a better opportunity, but this is definitely a company worth following, definitely a sector worth following as well. I do expect a lot of consolidation in the cyber space moving forward. But of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one.